earnings divided by what's on the books as equity is return on equity. So if earnings go up, obviously, good return on equity. If you take all of the financials in the market, in North American market, and you graph them on a line where you're plotting return on equity against price to book. So price to book is what you're paying for that book value that they have on the books. Return on equity is kind of the return you're making each year. There's a very solid line, a trend line that has a relationship between ROE and price to book. It's not surprising. What I'm willing to pay is tied to their ROE. So the trick here is that when a company beats on earnings and beats on ROE, it tends to move up that trend line and earn itself a higher price to book multiple. So you're really, again, you're trying to figure out, am I paying 15% ROEs, or I'm paying for 13% ROEs or 12? And when we looked at Fairfax last year, we could see very clearly that they were priced for sub 15% ROEs with a trend line for earnings and for ROEs that looked pretty healthy, and it was a good buy. So we bought some last year. We held it. It ran up through $2,500. And then as we look forward, again, always looking forward, we're starting to see that this insurance premium market that they're in is a bit softer. You might start to come into some losses on underwriting that was written the last couple of years. Peers, their valuation multiples are coming down, and the ROE now may not be as certain to exceed 15%, but we're paying now probably for better than 15%. So that's where we decided to take our profits and exit.